You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
I'm Bill Powers. Thanks for tuning in to Mining Stock Education. And in this episode, you're going to hear from some of the voices of wisdom that I've interviewed and featured over the last 7+ years. Some of these people you're going to hear from today dates back to interviews we did back to 2018. And the topic deals with how to use Analyst company reports. You'll hear from Michael Gentile. He's a strategic resource investor. You'll also hear from Tyron Breytenbach. He's a mining investment professional, worked as an executive as well as on the sell side, writing research reports. He's going to talk about, can you trust sell side research reports? You're going to hear from Warren Irwin. This one goes back to 2018, and he's going to discuss where dishonesty most frequently surfaces in official regulatory filings. Then you'll hear from Tyron Breytenbach again. He's going to talk about the key things to look for in a technical report, because as mining investors, we rely on the technical reports, that they would be honest. And Tyron talks about what you should look for when you're reading those reports, especially as a non-technically or geologically trained investor. Rick Rule is going to talk about, in answer to one of my questions, about how to vet or discern a definitive feasibility study for a developer. And then you're going to hear from yours truly, and I'm going to talk about why you must discern bias and also the usefulness of the mining investment content that you consume. So we consume analyst reports, we consume the official filings of the companies, and we also consume podcasts and writings and newsletters and things like that. So all of these things factor into how we make our investment decisions. And this episode of Mining Stock Education today talks about what we should do with this information. And finally, you'll hear from Dr. Rob Stevens, and he's going to answer the question, how long does it take for a non-technically trained investor to gain the knowledge needed to be successful in the resource sector? So this is a compilation of some of the past wisdom that I've featured over the years on this show, and we're going to jump right into it now. Enjoy. Mike, putting on your institutional hat, which you've referenced, going back to those days, when you would look at analyst reports and price targets, did you put any credence in the price targets? Were they of any value to you?
There's a bit of it's a game. I call it, game's not a nice word, but analyst covers a stock at $2 who thinks, to Dave's point, fundamental value is $20 long term. They'll never put a $20 price target on a stock. There's a bit of a stair-step approach that they use. So they'll say $2 target, strong buy $4, and then the stock will go to $4, and they get further confirmation. They'll go from $4 to $8 target, and so on, right? So I think analysts have a lot of value. I talk to them quite often, still do, my new institutional venture that I'm starting, but I use them really, they're encyclopedias of knowledge. They know these companies better than 99% of investors on the street, but the job of an institutional money manager or investor is to come to their own conclusion. So I would ask them their opinion, the facts, information on the permitting, on the geology, on the timelines, on the history of the asset, on the management. But my job as a portfolio manager is to make a decision for my clients. And so they're very valuable, but really early on in my early 20s of my career, you see an analyst report say, this strong buy, $20, I got to buy it because so-and-so said they buy it. But you learn quickly, you got to do your own work, right? And so that's key to me, but the price target really should be generated by your own due diligence, your understanding, and your price target can be vastly different than what the analyst price targets are. And that's okay. It's different mindset, different longer term view, or different valuation paradigm you may have versus the analyst.
Can my listeners trust the sell side information that's put out there? Research reports such as you used to produce for your former employer?
Yeah, so the research spectrum is all over the place, right? You get some research analysts are just mouthpieces for the investment bankers. Okay, they tend to not stick around long, because if your investor clients aren't making money, then you're not going to make money long term as an investor. I think it's important to just understand the inherent conflict of interest, right? Like, they are selling something, and there are two kinds of pitches from research analysts, more from a sales desk, really. It's there's the product they are told to solve, because it's what their investment bankers have on the desk right now, and then there's the other product where, yeah, they're going to make some money off the trade or off the deal, but they really, really like it, right? And investment banks should be compensated. They take a lot of risk. They play an important role in the ecosystem, but you can usually tell what sort of pitch you're getting. And this is why conversations are important, right? Because you have to be careful what you put in writing as a research analyst. Because if I'm a research analyst covering 20 companies, I need to be able to contact the management team. I need to be able to go on these site tours. If I have a bunch of nasty research out there, I'm not going to get invited, right? And so research analysts often get lambasted for softball questions on conference calls. And it's like, that's their job. They are supposed to, play both sides and help investors navigate the market, but also have access to management team. And then something else I find interesting is retail looks at a target price and they give it so much weight. But I can tell the institutions don't care about the target price. The target price is a direction, right? So when I had a lot of conviction about an idea, I would put on a crazy target price. Like it'd be a $2 stock and I'd go $10. And I knew the phone would ring, right? Because it's like, are you nuts? It's like, yeah, it's probably not going to $10, but it's definitely going to $6, right? And so it's directionality.
You weren't concerned about your reputation? Because I've been told the analyst, you stair step your target prices up, right? Like once you prove your thesis a little, you have more confidence to raise it.
If it's a well-covered name, you do that. But if you're trying to get attention and if you have conviction, you better have conviction, right? And I think if I put a $10 target on a $2 stock and it goes to $6, and my investors,
you still look good.
That's a great outcome for everyone. And then something else, like one investor told me, I call the guy with the highest target and the lowest target, right? And nobody needs a consensus hugger, right? Like the other thing to remember about the sell side is they get paid for being interesting and having an opinion, right? And to have an opinion, you're going to be wrong. Like you need to be right 70% of the time. Like you'll be a great analyst if you're right 70% of the time. But if you have the same market view as anyone else, I would never call you. You have no value to me, right? So a lot of young analysts make the mistake of just never wanting to be wrong. And I think you won't make a good analyst. And these investors listen to analysts, but not like these investors are sophisticated. They're not going to call one guy and do what he says. It's just one opinion. They appreciate the opinion. It's just one data point that they mix with all of their other data points before they make their decision.
Where do you most frequently see dishonesty when it comes to official regulatory filings? You have the PEA, the pre-feasibility, feasibility, the resource estimates. What documents do you most frequently see dishonesty in?
Yeah, well, I think the consultants take the resource estimates reasonably seriously. And I have not been able to see outright fraud in those at all, based on my experience. I've run parallel resource estimates myself using our own techniques, and I've generally found that when we've done that, they've come reasonably close to what the estimates are out there. Oftentimes, the consultants will actually be a little bit conservative on it. But I don't see that's really where the issue is. And when you get into pre-feas and feasibility, the level of rigor that goes into those is considerably higher than the PEA. The area I find the biggest amount of dishonesty is with PEAs, and I can't frankly believe it that some of these consultants will sign off on some of these PEAs.
So are they almost useless? It's more just a promotional item?
I imagine there are some PEAs that are useful, but for instance, with the junior market, I'll give you an example. I know of one very well-known mining stock promoter, and I went to visit all his properties, and I asked them what the IRR was on their project. They said, well, after-tax IRR of 15, 18%, which is not great, not terribly bad, and so they're hanging that on their, hanging that up to tell everybody what their after-tax IRR is. But when you look at their PEA, you realize that, the commodity price they used is 50 to 75% higher in the PEA. That was, I found that completely disgusting to see that, but that happens all the time. There's another example, too, where... of course, the biggest one you have to look for is look in the appendix of the PEA and find out the commodity price assumptions. They love to use long-term commodity price assumptions rather than spot. And this one instance, it's just absolutely hilarious. Not only did they juice the number on the commodity price they used, which is completely ridiculous, but the reality is the mine will, under no circumstances, in my opinion, ever get built. Period. End of story. So instead of the PEA basically saying, where any competent consultant would basically say, come on, kids, this mine will never get built due to environmental challenges and a host of other issues, which are pretty obvious. And I don't want to get into the specifics of it because it would actually tip my hand as to what the company is. But it's out there today, trading with a big market cap, and everybody thinks it's going to be a mine someday, and it'll never be a mine someday, and it's absolutely ridiculous that the PEA is out there, and leading novice investors to actually think this mine actually might get built someday, and it won't get built someday, and that's where I find the PEA is the really the weakest part of the whole process put in place following Bre-X.
So there's the least accountability with that document.
Oh yeah, absolutely. Look, if you look at some of them, and you look at the capex numbers to build mills or whatever, they are laughable. Some of them, it really is a joke. And I talk to mining engineers, and I run the PEAs by them, and they go, "Oh wow." They must have really been under a lot of pressure by management to crank down those capital numbers to make the numbers work, and that's the issue. And watch out for PEAs. There's a lot of fantasy PEAs out there, that's for sure.
When it comes to technical reports, I remember investing in a developer, and I downloaded the 400-page PDF of their pre-feasibility study. And I said, am I sure I'm going to invest in these companies? I have no idea what this is even saying. Like, for a retail investor, they get one of these technical reports. What are the key things to look for?
Yeah, so a couple of things I would zoom right into is just go to the search bar of the PDF and type CV, which stands for coefficient of variation. And it just tells you how nuggety the ore body is, right? So if you have a CV of 20, it's an insanely nuggety ore body, and they better be capping it very aggressively. Another thing I would look at is the resource table. They often show it at different cutoff grades. So if a project has, let's say, a resource grade of 8 grams, but they're using a 2 gram cutoff, okay? What happens when you move the cutoff to 4 grams? Do you lose a bunch of gold, right? Or does the grade go up, but you have fewer tons and the same amount of gold? So looking at the deposit through various cutoff grades tells you how resilient it's going to be. And if they only show you the resource at one cutoff grade, that's a problem. You also want as much blue sky between the resource grade and the cutoff grade as possible. So if you have a 2 gram deposit and a 1.5 gram cutoff grade, right, for underground mine, like, that's a problem, right? If your mining costs are wrong, the deposit doesn't work. So cutoff grades, CV, and then capping, like Google capping or search capping, and then see, do they cap the deposit? And if they don't, when I say cap the deposit, I mean gold is inherently geostatistically difficult. You have outliers in the population, and you are supposed to remove them. And it's difficult because sometimes all the gold is in the outliers. So not capping a deposit is not the end of the world, but just, read the section where they talk about capping and why they're not capping it, right? So, for example, Pretium didn't cap their grade because 90% of the gold was in an outlier. But it's worth reading that section. And then at the end of the report, there's usually a section called validation. And what they'll do is they'll run a bunch of plots and just show how their estimate is holding up. So they've done the estimate, they've counted how much gold is in the ground, and then they give you some examples. And one of the things they do is show you a cross section of the raw drill hole and the blocks. And if the drill hole is green with no grade, and the blocks behind it are bright red, you've got a problem, right? But if the raw data is overall matching the block model, then it means their recipe for calculating gold grades is generally matching nature. So those are some of the things that I would whiz through.
So a developer goes through a many-year stage to get to the feasibility study. They issue the feasibility study. I've looked at some of them. I don't understand them, but they're 400 pages, 500 pages long. Now, if you get your PhD, you have to defend your thesis, your dissertation, before they give you the degree. Do you think it would be helpful for companies to have to defend their feasibility study to their peers before it's issued, or functionally, is it just like the majors that vet these projects are the ones who, vet the dissertation, so to speak?
I hope over the next 10 years that a class of consultants emerges that investors can pay to do this for on a subscription basis. But right now, investors rely on the investment banks, which is silly. That's relying on the fox to guard the hen house. The investment bank's client is the issuer, not the investor. I personally pay a lot of money to consultants. I pay for geological consultants. I pay for engineering consultants. I pay to have feasibility studies torn apart, at least for that part of it, which I can't tear apart. It is not uncommon for me at all, if I'm going to invest $1 million or $2 million in a private placement, to spend $30,000 or $35,000 information gathering from sources of information that are loyal to me, and by the way, unique to me. I don't allow them to share the benefit of that with investors who, unlike myself, didn't pay for it. And I think that more investors will have to do this. Or rather, I think more investors should do this.
And will you go for competing opinions when you're trying to vet something? Will you seek out an alternative opinion to maybe the first opinion that comes in through a consultant?
It depends. If I think my consultant is the best consultant available to me relative to the task at hand, I don't feel the need to. I remember very well attending several business meetings presided over by Lucas Lundin, where the Lundin family, rest in peace, Lucas, where the Lundin family was trying to make an investment decision. And Lucas would say, okay, we're 15 hours into this. We know everything that we are ever going to know in the period of time that's necessary to make the decision. Now, in the next 5 minutes, we're going to make a decision. And if it's wrong, we're going to fix it. There is something called paralysis by analysis. I know 2 or 3 geological consultants who are on a first-name basis with tertiary volcanic, accreted terrain in the Cordillera, and porphyry deposits and epithermal gold deposits. And if I get the considered opinion of one of those about an exploration project that is in the terrain that he is an expert on, I'm good. Doesn't mean I'm right. What it means is that I have outcompeted my peers to the extent that I'm able to do it. And I believe that it is probable that I know enough to make the investment, and that I know more about the investment than 99% of the people who are going to make it. You need to know, Bill, in exploration, that the probability is that you make a bad decision. What that means is that you only should make investments where the size of the prize is substantial enough that the win that you enjoy on your successful speculations can amortize your unsuccessful speculations. I have zero interest in a speculation which could result in a double. If I'm not making a speculative bet where my upside is 5-fold or 10-fold, I have zero interest, because the upside on a double doesn't amortize for failures, which is what I expect in the course of a successful effort.
There's a lot of information in written and in interview format, including on this show, that's on the internet. And you need to decide what information sources you find useful. And even when you're presented with useful information, you always need to verify it for yourself. And a sub-point of this would be that all the information you consume is biased in some way or another. Sometimes it's biased in a negative way, not just in a positive or promotional way. So you need to understand that when you have an analyst report, the way the industry works is a lot of times the reports that I've read, after I read the report, then I go back to the issuer's website who issued the report, and I just see how they're compensated. Sometimes it's we write a report for $25,000. Sometimes it's we write a report for $50,000, and then they stress we're independent and the company, after paying us, has no sway over what we do or do not write. And okay, there may be a little bit of truth, but honestly, they're not going to get a lot of business if they don't say something at least mildly positive about the company, and they won't get referrals. So they're biased. Or a sell-side broker that his or her firm issues a report Well, that report is out there in order to get people to buy the stock because they're selling the stock and they make their commission off of the stock. Or everything sponsored based interviews, it doesn't mean it's not useful, but you should always be aware that everybody is conflicted. So in that sense, you don't want to swallow something whole right away. You want to know what you're buying. You got to be able to say 3 reasons why you bought it, 3 main risks. Even a company we featured recently that has performed well in the market, I liked how one of the YouTube comments said that it sounded good when you featured it, Bill, but it ran up another 30% while I did my due diligence before I eventually bought it. And that's the perspective that you want to have. Even if a stock runs because it's featured, stop, do your due diligence. If after you do a little further due diligence and it looks good, then buy the stock. But decide what information sources you find useful. But even after you use those sources, always verify the information for yourself. One of the reasons why those of us that don't come from a mining background are attracted to it, as you know, the potential upside can be great, not only with discovery, but because of the boom-bust cycle and just the nature of mining, there's the potential for outsized returns, albeit with a lot of risk. With that being said, for someone that understands the capital markets and investing, but they don't have a knowledge of mineral exploration and mining, what would you say, based on your role as a teacher and professor, what's the approximate average time for an individual once they really devote themselves to learning more to really become efficient at resource investing?
Well, I guess if I take that from a sort of a technical point of view, being able to understand some of those technical aspects, geological, mineral exploration, mining, I think to become good at it and knowledgeable, it probably takes a few years, and I don't want to sound pessimistic, but it's sort of that experience, not only having a knowledge of some of the technical aspects, but then applying that and using that to decipher news releases, to follow companies. And I think, the more experience one has, the better ultimately that you'll get on that. But with that said, you certainly don't need a geology degree. And in fact, if that was the route to success in this whole thing, there'd be a lot of really rich geologists, and I don't see those people all walking around. So, a little bit of key knowledge is important, and I think you can actually build that, in a few months of some sort of dedicated work, doing your own reading and research, and then applying that to companies and talking to the companies. I think that's important, is stretching that knowledge that you've gained by asking companies to tell you more about what they're working on, and asking them for some of that technical information, and that'll help to build experience and knowledge to be successful ultimately.